Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 27th of June. I'm Daniel Lam, your host for the podcast. The events in Russia last weekend was quite dramatic. Even though the sudden uprising was over too fast to have any immediate impact on the war in Ukraine, Kiev may seek to exploit this weakness in Moscow, i.e. trying to up the scale of its counterattack. The Russian public, seeing the state of its military, may be even more reluctant to support the war in Ukraine. The risk here lies in escalation from Russia, such as the threat of using nuclear weapons. Now, in the case where this could lead to the two sides coming to the negotiation table and bringing a possible end to the conflict, the major region that may benefit the most would most likely be the euro area. With staying neutral euro area equities, the region is currently trading at a significant valuation discount, which could offset the negative impacts from the ECB's aggressive interest rate hikes. We see euro area equities slightly underperforming US ones because of its heavier value tilt. An environment of capped yields is continuing to lend tailwind to growth stocks. Now, if there were to be an end to the war, then there could be less disruption on the supply side, and that could put downward pressure to inflation, giving tailwind for euro area equities. Now, in terms of sectors, we overweight three of them. First of all, we upgraded technology in Europe to overweight. The semiconductor segment accounts for over 50% of the sector and is expected to benefit from investments into AI, driving strong earnings growth up to 2025. Consumer discretionary is upgraded to overweight. Luxury goods and autos continue to drive sector earnings and exceeded expectations in first quarter earnings this year. Finally, financials is upgraded to overweight as more interest rate hikes drive strong earnings growth and valuation remains attractive. Of these three sectors, an end to the war would be a tailwind for the euro area economy and is likely to act well for consumer discretionary and financials. In terms of the euro, lessening inflationary pressure may lead to ECB to pull back on its hawkish guidance. This means that interest rate differentials for the euro may narrow less than previously expected against the US dollar. However, this would likely be offset by the improvement in sentiment and economic growth. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.